So the Benjamin Graham quote here is that in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And I think people are well advised to build a company that wants to be weighed and not voted upon. And that means having good return on invested capital and having lots of free cash flow. But if you said to me, if I said, here's a job I would reject. If somebody came up to me and said, Jeff, I want your job to be to drive up the Amazon stock price and just manage that directly. Now, this might sound ridiculous to some of you, but many companies actually do this. They actually go out and they try to sell the stock. That's kind of the final output. And it's much better to say, okay, let's not do that. That's not going to be sustainable. It's kind of a silly approach. What are the inputs to a higher stock price? Okay, so let's keep working backwards. And you keep working backwards until you get to something that's controllable. And a controllable input for free cash flow would be something like lower cost structure. And then you back up from there and you say, okay, well, if we can improve our picking efficiency in our fulfillment centers and reduce defects. Defects are very, very costly. It's probably, reducing defects at the root is one of the best ways to lower cost structure. And so then that starts to be a job you would accept.